Welcome back to In Sync with Synchronomics. I'm James Holland, and I'm here with my co-host and co-founder, Jamie Linkowski.
Hello, everyone.
So far, we've been focusing on what we consider the bread and butter of the benefits world, which is healthcare and retirement. We talk about how valuable benefits are, not just for employers, but for employees as well. There are other benefits outside of there, dental, vision, life, that fit into this voluntary bucket, if you will. And we know it's been more prevalent in conversations as far as when it comes to renewals and retaining employees. So that's why we're super excited to have Kai Hand from Employee First join us today. He has over 2 decades worth of experience in the industry, and we look forward to learning more about voluntary benefits and how they're evolving within the space.
Thanks, James. I appreciate you asking me to participate. I love what you guys are doing, and I'm so pleased that you asked me to participate in this section for you.
I know you've been asked to join a whole number of podcasts prior, and we're very honored that you've chosen to have us be the first one you jumped on. Any particular reason why?
Great first question. I don't think that I was ever a great spokesperson for general audiences. Most of what I've done is training inside the business. And as my future unfolded, I find myself now speaking to people who aren't inside the business. And so I feel like the message for me to participate in the future is more important today than it's ever been. So training sales teams is one thing. Speaking to people about how it affects their life is a second piece. So I just feel like the timing is perfect for that conversation.
Just give us the quick, 30,000 foot background when it comes to voluntary benefits, how they got started, where they've evolved to.
I'll try and keep this part quick because I'm a nerd and I find it wildly fascinating, but I don't know that everybody will. Voluntary benefits, depending on who you believe, either started with 7 women after World War II that created an accidental death and dismemberment benefit insurance company because people were coming back from the war. Their husbands, their boyfriends, their side pieces, and they were coming back broken or dead. And they were having to pick up the pieces. And so that was the first really sort of benefit in the voluntary benefit space. Followed quickly thereafter by a wealthy family in Georgia discovered the old man around the corner got cancer, and it financially devastated the family. And no one could figure out why, because they were rich. And it was discovered that medical insurance, even in 1955, wasn't getting them where they needed to be. So those 2 policies started the voluntary benefit space. But it's a funny story because even today, when people talk about voluntary benefits, I know why people are confused. Last year, Forbes magazine listed voluntary benefits as gym memberships and discounts, which do not. But like ADP, our largest payroll company in America, lists voluntary benefits as workplace perks, which it's also not. So I know why people who aren't in the space get confused as to what we're doing, because where we look to for information seems to also be confused. Which is, I guess, the real reason why I wanted to join today, is to be clear about what are we doing and why are we doing it.
Yeah. Kai, that's good. James and I have been talking about retirement and healthcare in the last several episodes. We've seen a growth of voluntary benefits because in healthcare, the employer has been shifting the burden and the cost of healthcare onto the employees, and they're creating copays and deductibles and co-insurance. But if I'm running a company and I want to be as strategic as possible about my voluntary benefits, maybe I'm considering adding or cutting offerings. What do I need to know in that context?
Again, perfect intro. The voluntary benefit world was really established to help people pay for additional services that medical insurance wasn't paying for. When we look, some people say, oh, you use it to cover your medical expenses. And sure, some people do, but math tells us that less than 20% of the money that people receive from having these additional services ever see a doctor or hospital. It's really designed to protect the fabric of your life. Some people would say it's a shelter from the storm. We don't lean on medical insurance anymore like we used to, because in the past 10 years, medical insurance, anyone who used it realized it's too expensive to use. And I'll just give you some silly math. So we pulled some numbers this morning, and it said in 2012, 54% of people got medical insurance through work. And now we have 52% of people get medical insurance through work. So let's call it roughly a little more than half of our population. Now, you can say we can attribute that to the gig economy, people wanting to be not full-time insured. There's a host of reasons, or maybe they're getting protected by a spouse and not themselves. So the number can move a little bit, but it's still roughly half the population. And I offer you that to say, when I look at voluntary benefits, where in 2014 to 2024, accident coverage has had 188% growth. CI, critical care, heart attack, stroke coverage, 150% growth. And hospital, 213% growth. So when you look at where it fits, where it used to be something nice to add on for someone to feel like if they wanted additional coverage, they could get it. Now people, for a whole host of reasons, including a primary one, to attract and retain talent. Because if you are a certain level and above of talent and you're being pursued by a company, those medical benefits matter to you. And the entire benefit package now matters to you. So protecting your family, look, you may not be the one who's sick, but if you've got someone sick in your house, it's still going to distract you. So having coverage that protects the entire family, whatever that looks like for you, has never been more important than today. Because in the past 10 years, people went to use their medical insurance, and it was expensive to the point they couldn't afford it. It was nice before. Now it's like a requirement, because to your point on retirement, no one ever thinks that the old man's missing the stop sign, or the dog's going to bite them, or they're going to miss the last step. And not everything is that level, but some are bigger. And they end up tapping into their 401ks. They end up having to spend nest egg money because they got a little bit of this or a little bit of that, or someone in their family did. And no one plans for that. That's not the exposure or the way that people live. Employees prioritize everyday healthcare over the rare high dollar expense. And so, second loan on the house, a HELO, tapping into your retirement is the first place that people will go if they don't have the support of a voluntary product.
Yeah, and we talk about that too. We talk about the ALICE demographic, right? The asset limited, income constrained, yet employed. And I like the way you nerded out with the 54 and 52%. But we all have to remember that the population of the United States has grown, right? So those are bigger numbers of people that only half of those numbers only have health care. And it really begs the question, how much can they afford of that health care? Which is why I think you need to augment those programs with things like voluntary benefits. So how do you measure the success of a voluntary benefits plan? If you were an employer, how would you measure the success of a voluntary benefits plan?
I always think that even though I come from a sales perspective, the humanity in it is, I never look at the success or the win in a signature and sale. I look at it in a percentage of claim paid. I want to know, Jamie, that you put $10 into the pot and you got covered $10 back. I want to know that you're being met with actual support and coverage. And you may pay into it for a couple of years before you get a payout out that matches, but the agenda here is to support you and your family with a safety net of cash if you get sick or injured. And I vote how successful companies are by how fast, how clean, and how much they pay people back when they get sick or injured. That the metric is that I don't feel like we track hard enough.
I usually use the carrot stick analogy, and now that we've covered the carrots, we have to worry about the stick. And Jamie and I will dive into this, I'm sure, in future episodes, and I don't want to get too deep into the whole ERISA litigation, nuclear option. But employers now, when it comes to benefits, they're very suspect of that, because litigation everywhere on the 401k side and the healthcare side has grown so much. How do they design it? Because I know it used to be, you go out and you fill out the enrollment and everyone signs the form, and now there's enrollment website and things are automated. So how does the employer offer that benefit you just talked about, that quick payment, without exposing themselves to some other ERISA issue, or an issue they didn't think applied to the VB side that maybe applies to the other benefits?
And I feel like that this is my big moment. This is the message that I think is so important. When ACA came onto the marketplace, although not perfect, put a framework together to protect the employee, where it guaranteed that 85 cents of every dollar collected would see them back in claim or support. But they didn't do that in the voluntary benefit space. And that's where the divide happened. So ACA was great for medical insurance, but the fully insured voluntary benefits stayed on the side. And people aren't protected the way that they used to be in that space because now they're being manipulated as a revenue stream as opposed to a protection stream. And that's the backbone of our company, right? The whole concept of our company is, who is the CFO to your voluntary benefits? Are you seeing where the money is going, and is it going where you need it to be? So we know why large employers move to a self-insured model. It makes sense: visibility, control, access. But you still don't get that in the VB space. So in the voluntary benefit space, when I talk about accident, hospital, critical care, people don't know what their claims really are. They don't know where the money is really going. And when we look into it, sometimes over half of the money is being spent to pay commissions to people, not going back to the employee who is spending their money for the protection. And I think that we got off track partly because most employers offer it on a voluntary basis. So it's not really their money. They're taking money from the employees who are asking for the benefits, and they are just simply processing the money through the system because insurance carriers, who are also not the enemy, but they are now providing bigger benefits at lesser rate because being insured at work is a better risk than people being insured not at work. So now the employer is doing a good thing by shepherding the money through them so that they can get great policies at low rates. But what they're not doing is investigating where the money is being spent. And that's where I feel like the rub is. And that was where Employees First really came to market a couple of years back with a financial model that looks over the voluntary space and says, where's that dollar going? Who's getting paid? And is that the place we need it to go? And I worry that if somebody doesn't look into this and doesn't know where the money's going, they can't correct the error. And again, I'm not mad at insurance companies. I'm not mad at brokers. I'm not mad at anybody. I just want to make sure, because at the end of the day, the fiduciary responsibility lies with the employer. And so if the employer is bringing in these benefits and then looking the other way and the money isn't being directed in the correct way, they are looking at exposure. So our system, again, financial model, we have 6 amazing carriers that know that this is the future. They give us full transparency into claims triangles. I know who's getting injured, when they're getting injured, what they're paying, and we can aggregate that to return back into their system, sometimes up to 30 and 40% of the premium that they're spending in to put back into their medical systems. So just in the last 2 years alone that we've been using this financial model in this space, we've returned over $42 million. It's a lot of money when you're looking at $6 and $7 for a policy to return that level of money back into their system to use to support other medical issues. And there's a whole host of things you can spend money on because it feels like so many people have their money in the till now. Enrollment platforms, brokers, enrollment firms, they all want to get paid, and the dollar is only the dollar. And at some point, the employee has to see the return of that. Our model simply brings visibility into where the money's going. If it's going where you want it to go, great. But if it's not, my job is to make sure you know where it is and where you can put the funds that make sense for you and for your teams.
Yeah, love that. Love that.
That hits on one of the big themes here at Synchronomics, Kai, is the idea of, in the past, everything was a negotiation with someone on one side of the table and someone on the other, where we believe everyone can sit on the same side of the table. The carrier, the broker, yourself. Synchronomics is a way to design that so that cost aspect that you talked about, that dollar, because there is only one and it can only be chopped up so many ways. What are some of the, and again, what are just maybe one or two key things an employer wants to look at when they're having that conversation, in terms of not just for the cost of the insurance, but again, if they have a broker or advisor, what are one or two things they can do to just right away get a grasp on those things?
Sure. So we do reviews constantly. We are constantly reviewing large case employers. We can use assumptive models. We can use your actual numbers. We do assumptive modeling for people constantly to make sure that people understand where the money is and where it's going, and if that's where it's meant to go. In our model, it returns back some of that unspent premium, where we can now spend to do other things, because maybe you need a bigger, better enrollment platform, or maybe you need the policies to be designed bigger. But we can, with no rate increase to the policy, build bigger policies, create additional products, help with the enrollment platform, help with the enrollment strategy, create other lines of coverage. One of the things that I love about voluntary benefits in particular is that it really speaks to women as much as men. As a matter of fact, in 2025, we're going to see 36% of the new buyers be female. I'm sorry, 36% of all the full spend, and then 30% being male. So it's still driven more by female supports as more women are in the workplace looking at where this strategy goes. And just for reference, we talk about there being a $6 policy and $7 policy. We have started in 2012 at about $6 billion a year were spent in America to protect people for these additional benefits. In 2025, this year, the spend we are looking at it being somewhere between 9.8 and 9.9 billion dollars. So that's what it looks like in the 12, 13 year look. It's a 50% growth. People look to these benefits to protect not just the doctors and hospitals, which is what medical insurance is designed to do. It's really, again, designed to protect people and the families for the fabrics of their life. So that's what they do. They hire us, we come in, we look at their medical spend, we look at the VB spend, and we make sure that the money is proportionately going where it needs to go. And if it's not, then we help you get it to where it does need to go.
Great. So, and one of the things, again, that whole synchronomics, the whole process is to get all of these benefits working together, not just for the employer, but for the employee. And each company is going to different. They have different values. They have different focuses. We get all that. You mentioned the partnerships you have. Who are some of the carriers that have understood that the status quo is no longer going to work? They need to embrace this change that we've been talking about for the last 20 or 30 minutes.
I believe ultimately we will have many more carriers, but as people are seeing this as the future and they're realizing that they are going to be left behind if they don't sort of get in line, and this, whatever the ACA was for medical needs to happen in the VP space. And when that happens, I think we will see more carriers coming to us saying, hey, we need to be on board with this program. We have some of the best VB carriers in America that have asked to be part of our system. Our brokers tend to really like people like Voya and MetLife and Prudential, Sun Life. We have a number of really great carriers that understand that the future is going to be in supporting back the employees. So whether there's oversight today or not, no one wants to be caught sideways when the oversight comes. So whether you're just looking at, hey, how can I return back 25 to 30% of the spend back into my system? Or if you're looking to build up products, protect yourselves better, there's a whole host of reasons. I jokingly say, I know why HR brings us in. I know why the CFO brings us in. I know why your in-house legal counsel brings us in. What I don't understand is why everybody doesn't bring us in. This is the way of the future for us and for this space. And if we don't start protecting these employees better, I think the whole reason we brought these benefits in will be a loss for us.
So Kai, you mentioned some of the carriers, and a podcast of ours would not be complete without mentioning conflicts of interest, right?
Sure.
Yeah, James is laughing. Like, we got to get doom and gloom here. But if I'm sitting there and I have one of those carriers, I'm thinking I'm good, right?
Yep.
What are some of the red flags or conflicts people need to be aware of when it comes to voluntary benefits, even though I might be sitting there with one of those carriers as one of my carriers?
And listen, there are a bunch of carriers that I love that I think are really wonderful people. I just think that the business model didn't get corrected to meet people where they need to be met today. As people look at their medical benefits and they're trying to forecast the future, we want employees to feel protected and covered at work. We want to be able to keep our employees. Employee retention is a big deal, especially this time of year when everybody's getting their bonus, the end of the year, they're looking around. So employee retention as well as attraction is a big deal. And having this rounded up benefit package and knowing that where the future can be, we used to say, what's on your proverbial whiteboard, and can I help you solve it? And do you need a couple extra $1 million? And do you already have it? And we're just directing the funds the wrong way. Again, I don't think insurance companies are nefarious. I just think that we are gravitating to a different model today. And we are leading that championship to that championship march. We want to get people on board with what the future needs to look like.
Yeah. No, I love where you're going, right? So conflicts of interest, remediate that, check. Transparency, check. Full disclosure, check. And take care of your people, check. So I think that really is in line with a lot of the themes that we talk about when it comes to healthcare and retirement, right?
Yeah. Yep. So again, here we're all about ERISA, and all this benefit stuff is a team sport, and the idea of one person, the jack of all trades, the master of another approach. We that's why we want to look at partnering with professionals like Kai and the folks over at Employee First, because when someone comes to Synchronomics, we want to tell them, yes, we can in terms of helping, but we might not have the answer. That's why we find the folks who have been at this for decades, but also see the difference. The whole idea of the insurance companies controlling everything, which happened in retirement, which happens in healthcare, which needs to change because people want to have a bigger say. I think the big importance, especially on the voluntary side, is this is 100% employee money in most cases. Am I not correct? So this is not the employer very rarely contributing. So if you're not, that's two things you don't mess with: people's family and people's money, right? So therefore, this is where the employer needs to be on their game, because they have to be making sure if I'm spending my money here, what am I getting for it? So one of the things that we tend to, whether it's on purpose or now just the way it works, Jamie's very big on the so what, now what, in terms of, okay, we've had the conversation. What are employers doing? What do they need to do to make sure the voluntary benefits are in line with not just the values, but the compliance side that we talked about? Again, just to give us a couple of things that they can address.
So I love that you frame it that way, because, in your car, if you want to know if you need oil, there's a dipstick and you can check. Aside from the idiot gauge that I look at on there's also a way to check. I don't think employers are being good stewards of their employees' money. And if you want to use the dipstick to check out why, pull your actual claims, see what percentage of money is going back. And if you don't feel like it's the right amount of money that's actually going back, and pull your real claims. Don't pull future claims. Don't pull reserves. Pull the actual dollar. Ask your carrier for the actual dollar amount that's coming back to your employees. And that's your dipstick right there. And if you don't like what percentage that is, give me a call and we can walk through where the money's going, why it's going, where it's going, and if that's the direction you need to do. But being a better steward of your employees' money is going to become more and more important as we march on.
No doubt.
No, terrific. Yeah, great. Thank you, Kai. I appreciate you taking the time this morning. Super interesting. And again, something I think that's obviously out there in the news fairly constantly, whether even not just, like you said, industry rags, it's showing up everywhere in terms of conversations, in terms of employee benefit, retention, open enrollment. So if anyone wants to get in touch with Kai and his group, we'll have all of their information in the description. And of course, we always, as we're putting this ending together, we want to talk about all sorts of different benefits and how we can help you synchronize these things, not just for yourself as an employer, but your employee. And there are very few, if any, other full dual 402A fiduciaries in the space. So again, we welcome the conversation. Visit the website, synchronomics.com. And again, obviously, we look forward to speaking with everyone again for our next episode. Thank you guys very much for joining us today.